Okay, peeps, welcome back. So today we're going to be talking about the macro markets overview for November. Let's get it. So the first thing that I want to pull up here is the 200-week moving average. So we're going to take a quick look at this. You guys are probably going to be wondering, why is this so important? Well, I'm going to show you here in a minute. For those of you that have been following the channel for a while, you would know why this is significant. But for those of you that are new, we're going to point it out right now. So this white line right here, this is the 200-week moving average. So as you guys can see, basically since 2011, all the way back here, so almost 12 years now, this thing has bounced off of this 200-week moving average almost every single time, with the exception of the Black Swan event back in 2020. So why is that significant? Well, it matters because as long as we hold above it, we are technically bullish. This is considered to be the ultimate bull bear indicator for the S&P. And if we have a close below it and we start moving lower after a confirmed close below the 200-week moving average, well, that could potentially indicate a serious market drop coming. We're talking like 20, 30, 40, 50%. So yeah, let's kind of hope we don't see that. So that's the 200-week. The RSI and MACD are bullish. They had golden crosses. We are above the break-even level, and we are not overbought, so that's good. We had this break of this downtrend line here during the month of November, so that's also good. That's very bullish. You can see we broke out back up to this 4,600 level. We held this kind of macro trend line here that formed basically back during the pandemic lows. As you can see all the way back here, we have held on that support level, or support trend line, I mean. So an important thing that I want to point out here is you guys can see that we had a candle close here, and then we had a higher one here, and we just barely eked out a higher candle close here, but you can see that it did actually close higher. So what am I expecting from this point? Well, what I actually am expecting is for the S&P to move up to 4,700 or about 4,710 before potentially seeing some resistance. The reason I say that is because we've had higher highs this entire time. And I mean, it's possible it could pull back a little bit, maybe to the EMAs, and then start moving to the upside. But I think the probability, in my opinion, is higher that we're going to move straight into that 4,700 level at this point. So with that being said, let's look at the NASDAQ. Oh, one other thing I did want to point out on the S&P before we go over to the NASDAQ. So let's take a look at the percentage gains here from where we are now to the highs. We would need to move about 5% more to the upside to break the previous highs at 4,800. So similar thing on NASDAQ, golden crosses on all three indicators. We are above the break-even levels on these two. We're not overbought, so that's all good and great. That's considered to be bullish overall. We did have a higher candle close above these previous candles, so that's bullish. Could expect the NASDAQ to move into the highs here soon. And we actually did not even get a death cross on the EMA, so that's also bullish. And we broke this downtrend line. So with all that being said, from the current price to the highs would be about another 5.7% move, so slightly less than the S&P. Now we'll go over the Dow Jones, which in my opinion is the most bullish chart out of all four of these indexes. So you can see the RSI and the MACD are above the break even. They had golden crosses and they're not overbought, so that's bullish. And we did have a previous candle close here, as you can see on the Dow Jones, at about 36,200. It was way, way over these candle closes back here during July of 2023. As you can see, it basically just pretty much destroyed that resistance level. But it did get kind of stopped short a little bit just before these candle body closes up here. So we would need to see a candle body green candle close above these closes from back in 2021 to actually see it push the highs and to be able to sustain an uptrend without getting sold off by the bears. So from the current levels, we're sitting roughly about 2.64% from the highs. Note we are in a resistance zone here. I am overall bullish on this. We broke this downtrend. We've had basically a moonshot from that point pretty much in the month of November. So now the Russell 2000s, last one we're going to look at here. So you guys can see we are still below. We're more or less below the break-even levels on the MACD and the RSI, so this thing does still have to move up quite a bit to get bullish. but we have bounced many times off of this support zone between 1600 to 1700. That's bullish. And as for the trend line, uptrend line, you guys can see that we have more or less basically held that over time, minus the black swan event, of course. And we have been bouncing off of this previous resistance turn support, which we are now trying to bounce off of as we speak. So I am actually most bullish on the Russell 2000. Reason I say this is because it has the largest upside move to come out of all the other indexes. The other ones are basically sitting at highs, whereas this one has roughly about 32% to go. But we are on the verge of having a golden cross on the EMAs, so that's good. If we have that, then it could be some serious upside to come. We'd basically need to close above roughly about, I would say roughly about 1980 to 2020, and then above 2090 on the Russell 2000, and then we could see some serious upside after that point. So with that being said, let's now move over to the stocks above the 50-day moving average as soon as I can find it. So here we go. As you guys can see, we basically just moonshot off of this level down here at support. Why does this matter? So you guys can see throughout history, throughout the last 3 years, we've only bounced off of this area or even come down to this area roughly about 4, maybe 5 times if you include this. And we've only hit it so far 5 times over the last 3 years. So basically what this is this is an inverse indicator. So when it's down here in the green zone, that's typically a perfect buying opportunity. When it's up here, that's a perfect selling opportunity. So we're getting pretty close to overbought here. I don't really look at these indicators too much for it, but they are still technically not bullish because they're not fully over the break-even levels. So we could see something like a pullback into the EMAs, and then these move up, and then another move to the upside with the price action into this overbought territory. So very similar story on NASDAQ. NASDAQ is actually not as overbought as the S&P 500, which I find to be quite interesting because the NASDAQ is more volatile than the S&P. But yeah, we're getting pretty close to that overbought territory, so definitely want to keep an eye out on that. As you guys can see from the oversold territory, we pretty much just ripped straight up. So now we're going to get into the 200s. So this is the NASDAQ version. As you guys can see, we have not bounced off of this zone that many times throughout history, and we have also not sold off of it that many times. So we sold off from the market peaks back here in November to February 2021. Here's your pandemic low, and this is when the Fed was raising rates back during when Trump was, or cutting rates, I'm sorry, back during when Trump was president. So, and then this was the bear market bottom from last year. And this was your July pullback, or 10% correction this year. So we're basically sitting, I'd say, at a pretty good level. I'd say for the 200, there's probably quite a bit more room to run up after that big retracement. Not really bullish, not really bearish on this. We'll just have to wait and see what happens. So the S&P 500, very similar story. There's a lot of correlation here. You can see, again, 2018, the pandemic lows, the previous all-time market highs when the Fed said they were going to raise rates and then did start raising rates. This was the bear market low back here. And then this was kind of right here was our 10% correction this year starting in July. So again, not really bullish, not really bearish. The indicators and the price action here are kind of indicating possible indecision. It is above the EMAs, which is bullish, so we could move up. But we'll just have to wait and see on that one. So with that being said, we'll take a look now at the yields on bonds. So the 10-year bond, as you guys can see, has had almost a triple death cross. So we had a death cross on the RSI and the MACD. We sold off from overbought territory. And we've had a large red engulfing candle confirmed below these EMAs. I'm expecting the death cross to take place here soon. Basically, what I would want to see on this is that we close below. Well, basically, what we're really looking for here is a close below this 3.4 level. If we get that, then I would say some serious selling off of the bond yields will be taking place. So here's the 2-year. You can see pretty similar story. We had a triple death cross. This one did actually have a death cross. You can barely see it, but it's right there. We had that red engulfing candle, so that's also very bearish. We want to see it come back down below 3.8% with a body close, I would say, to have this thing really accelerate a sell-off. So in order for this thing to uninvert and the Fed, well, basically it's probably not going to uninvert until the Fed starts cutting rates. But for that to happen, we would need to see the 2-year yield come below the 10-year yield. Then you might potentially be looking at a market sell-off. But if I'm being completely honest, based on the bear market we had last year, which was really, really bad. I mean, you had Tesla and Facebook down 80% from highs, and that's part of the Magnificent Seven. I would say that the market probably already priced in the sell-off. And in my opinion, don't quote me on this, history does actually support a market dump if it uninverts. But in my opinion, I think that we're actually going to go higher in 2024. We're going to have a melt up. That's what I think is going to happen. So Fed funds rate, not really much going on here. You can see they're still holding. Pretty much every time they've ever held throughout history, they've never, ever raised again. Well, in recent times anyways, you guys can see that they pretty much just hold, and then at some point they cut. So not really a lot going on. They've been basically holding since August, so quite a few months now. We are expecting them to cut probably, I would say, by March of next year at the latest, is kind of what I'm thinking is going to happen. So in terms of inflation, core inflation or PCE inflation has come down quite a bit. You can see the pretty much all the indicators are pointing towards a sell-off or basically a downtrend in core PCE. What we would like to see is for it to kind of get roughly down to this, I would say, 2.5 to 3 level to, really be looking good on core PCE inflation. Headline inflation is actually looking really good. What we want to see is we want to see a close below 3%. Somewhere probably, I would say, roughly about 2.5% would be a really solid indicator that inflation's basically done and the Fed has it under control. Unemployment rate, as you guys can see, we have had golden crosses on these, so that's not really good. Pretty much every time we've seen this in the past, you can see here, if we zoom in a little bit, you can see pretty much every single time we've had a golden cross, it has ultimately led to a massive spike in unemployment, and the inverse is also true. But we're kind of thinking that unemployment is not really going to go up. It's more or less going to stay flat is what we're thinking is going to happen, because as soon as the Fed starts cutting rates, that reduces the rate of borrowing for both consumers and businesses. And what that means ultimately is that it's cheaper to conduct business, which should have basically how do I want to say this? A hedging effect against the rise in unemployment. So basically, if unemployment was going to go up, as soon as they start cutting rates, we expect unemployment to go back down, is more or less what I'm saying. So we're going to go now down to oil, which has been kind of our favorite topic as of late. So we're going to take a look at the oil chart. And we're going to scroll over to the weekly here. So you guys can see that we had a death cross on the MACD and the RSI. We've had multiple weeks of downtrends. You guys can see we closed below this uptrending level basically since the pandemic lows. So where could oil go at this point? Well, I think most likely we'll probably hit the bottom of this range at some point, roughly about $61 a barrel. I would say if it's at $60 a barrel, that's pretty comfortable. Gas prices should hopefully come down. It would make oil stocks and oil ETFs a lot cheaper to buy. Just so y'all know, we are picking up some USOI. We have been for the last few days because it's come down quite a bit. So that's oil. Now we're going to take a look at the metals. So we're going to start with gold here. You guys can see that gold did kind of have a fake out here to the upside on the weekly time frame. So yeah, that giant wick there, that's actually kind of bearish, to be honest. And then you can see we basically sold straight back down. So that would favor the bears, but to be honest, I'm actually still bullish on gold. The reason being is because we've had the previous week, we had a massive green candle close above all of these previous candle closes, going back to basically the pandemic lows. You guys can see that throughout history, we have never gone back down below this. Well, I shouldn't say we've never gone back down below it, but the highs on any given candle in terms of the macro view has only ever gone up. So we have this candle here, and then we have a high here, a little bit lower high here, and then it goes back up again, and then you have this big, huge green candle. So in terms of where the price could go, honestly, in price discovery mode, it's hard to say. We don't really want to buy unless it gets back into this zone right here. So now we're going to go over to silver. Still kind of sitting in the middle of nowhere. It's not at the highs, which is basically between 29 to, if we scroll back here a little bit, you can see during the previous recession we had, all the way up to $50. But we don't really want to buy this unless it gets basically between, I would say, like about $9 to roughly about $15 per ounce. So oil is, or not oil, copper is still looking okay. It's a little bit expensive for our taste. We don't want to buy up here, but if it does break bullish out of this, the price target for it would be, I think I got this target maybe like off of the monthly or something. But yeah, if this is actually a bull flag, the target would be about $6.80 per ounce. But again, we don't really want to buy until it's at least $2 an ounce, I would say. So palladium's looking pretty good in terms of buying. You can see the high is roughly about $3,500. The resistance starts at about $3,000, but the price is currently at $1,400. We don't really want to buy anything until it gets to roughly about $850 to $1150 an ounce. Reason being is because that's where the previous major support zone or resistance turn support was, and yeah, we just don't want to buy unless it's really, really cheap. So we'll take a quick look at Bitcoin here. As you guys can see, Bitcoin is just basically ripping. It pretty much blasted straight out of this bullish pennant pattern. The target for this is about 47,000. We may end up seeing some sell-off at that point. We'll just have to wait and see, but everything looks bullish. The RSI is overbought, just so y'all know. That is a warning signal. So now we're going to go over to the DXY. Take a quick look at the DXY. It is still holding this trend line and the support zone. That's not what we want to see. Basically, if crypto is really going to skyrocket, pretty much we want to see the DXY break both this zone and this trend line and come down to at least this 94 level. Then we would start to really see crypto really start smashing to the upside. But as of right now, I am still bullish on the DXY. Reason being is because we haven't broken the previous peak here, and every single time this thing has tried to pump up, it's effectively got rejected and basically shot back down into the support. So the more times it touches the support or a resistance level, the more likely it is to break that level. So if it keeps hitting the support, we're expecting it to at some point break down and start selling off. So the VIX, not really much going on there. Pretty much at the lows, that's good. That means risk on assets are moving up. If the VIX was moving up, that would be kind of scary because that means that risk on assets would be selling off probably pretty hard, and we definitely don't want to see that. And yeah, so that pretty much wraps up the overall macro markets overview for November. Hope you all enjoyed this content. Please like, comment, and subscribe, and we'll see y'all later. Peace.